All right, let's talk about money. Today, we are going to learn its language. We're going to break down two of the most basic ideas out there, saving and borrowing, to get to the bottom of why a dollar in your hand today isn't the same thing as a dollar a year from now.
So let's just dive right in with a question. Imagine I offered you $1,000 right now, cash in hand, or the exact same amount, $1,000, but you have to wait a full year to get it. Which one do you take? Come on, be honest. You'd take the money now, right? Well, it turns out that gut feeling you have is actually a fundamental principle of finance.
And there's a name for this principle, the time value of money. It's a fancy way of saying that money you have right now is more valuable than the same amount in the future. So why is that? Well, it boils down to two big reasons. First, you could take that money today and invest it. You could put it to work, and it could grow into more than $1,000 by next year. And second, let's be real, there's the human side of things. We just prefer having things now instead of later.
Okay, so if money today is more valuable because it has this potential to grow, what's actually driving that growth? What's the engine? Well, it's an incredibly powerful force called compound interest. You see, interest kind of comes in two flavors. On one hand, you've got simple interest. It's, well, simple. You earn interest only on the money you first put in. It's just a straight line of growth. But then, on the other hand, you have compound interest, and this is where things get really, really interesting. With compounding, you earn interest on your initial investment and on all the interest you've already piled up. Your money starts making its own money. And this chart just shows it perfectly. The blue line is simple interest chugging along at 5%. The orange line, that's compound interest, and get this, it's at a lower rate, 4.5%. For the first decade or so, they look pretty close, right? But then, look what happens. The orange line starts to curve, it takes off, and it just leaves the straight blue line in the dust. That right there is the power of compounding over time. It's why time is probably the most valuable asset you have when you're investing.
This idea is so powerful, it's said that Albert Einstein called it the eighth wonder of the world. And its quote is perfect. He who understands it earns it. He who doesn't pays it. And that is so true. This force works both ways. When you're saving and investing, it's your best friend. But when you're borrowing money on a credit card or a loan, it's working against you.
So we know compounding is a huge deal, but what actually sets the interest rate you get, or the rate you pay? To figure that out, we need to zoom out a little and look at the bigger picture of rates, risk, and return.
It's not just one thing. It's a mix of factors. You've got the term to maturity, basically how long the money is going to be tied up. Usually, the longer the term, the higher the rate. Then there's default risk, which is just the lender wondering, hey, what are the chances this person doesn't pay me back? The higher the risk, the higher the rate. And of course, you have huge factors like the health of the entire economy, and even just simple stuff like banks competing with each other for your money.
You know, economists have this really cool tool to see the relationship between time and interest rates all in one snapshot. It's called the Treasury Yield Curve. All this graph does is plot the interest rates or yields for U.S. government bonds for different lengths of time, from super short-term to way out at 30 years.
Now, normally, the curve slopes up like you see with those green and orange lines. It makes sense, right? You get paid more to lock your money away for a longer time. But every once in a while, something weird happens. The curve flips. It inverts, like that blue line at the top. Suddenly, short-term rates are higher than long-term rates. For economists, this is a major red flag. It often means investors are nervous about the near future, and it can be a surprisingly accurate predictor that a recession might be on the way.
Okay, so even if you've got a great interest rate and your money is compounding away, there's another force out there working silently against your savings. We need to talk about fighting the inflation thief and protecting your actual purchasing power.
So what is inflation? It's simply the rise in prices for everything, which means your money buys less than it used to. Think of it like a leak in your financial boat. If your savings aren't growing faster than inflation, you're actually losing ground. You might have the same number of dollars, but they just don't stretch as far.
Let's make this totally clear with an example. Let's say your savings account is paying you 3% interest for the year. That's your nominal return. It's the number you see on the bank statement. But over that exact same year, the cost of everything else, groceries, gas, you name it, went up by 2%. That's our inflation thief, silently taking a 2% chunk out of your money's value. So here's the million-dollar question. After you account for that thief, how much richer are you really?
What's your actual real gain in what you can go out and buy? Your real return is only 1%. Yep, even though your account balance went up by 3%, your actual purchasing power only increased by 1%. That's the number that really truly matters.
And this simple little calculation we just did has a name. It's called the Fisher equation. Basically, your real rate is just your nominal rate minus the inflation rate. It's the essential formula you need to figure out if your money is actually working for you or if it's falling behind.
Okay, we've covered the time value of money, the magic of compounding, what drives interest rates, and the silent threat of inflation. So, how do we use this new language to tackle real-life financial goals? Let's put all the pieces together.
Let's lay out a mission. The goal, retire in 40 years with the same buying power that $1 million has today. The challenge, of course, is inflation. That future $1 million is actually going to have to be a much bigger number. Our engine is compounding. We'll assume our investments grow at 5% a year. So the big question is, how much do we actually have to save every single year to hit that target?
And when you apply all the principles we've just talked about, you discount for inflation, you factor in compounding, you can get a real precise answer. To hit that goal, you would need to save $25,717.79 every single year. See? What seemed like this huge, vague, maybe impossible goal becomes a clear, concrete, and actionable plan. That is the power of speaking the language of money.
So we've gone over the vocabulary, from the time value of money all the way to real returns. But these aren't just terms to memorize. They're the actual tools you use to design and build your own financial future. So the only question left for you is, now that you know the language, what story are you going to make it tell?